Sarah buys a rental property. David puts the same money into index funds. Both of them are convinced they made the smarter move. Both of them are missing something critical. Because when you actually run the real numbers over 20 years, including every hidden cost and every silent advantage, the gap between what you think you will make and what you actually keep will genuinely shock you. Let us set this up fairly. Sarah and David both have $50,000 saved. Same income, same age, same city, same financial starting point. The only difference is what they each do with that $50,000. Sarah uses it as a down payment on a $250,000 rental property. David drops the same $50,000 into a total stock market index fund and sets up automatic monthly contributions. Same money, completely different paths. On day one, Sarah has a house, a tenant, and a story to tell everyone at dinner. David has a brokerage account and a confirmation email. It is not even close in terms of how exciting each choice feels. Sarah drives past her property on the way to work and thinks, I own that building. David logs into his account once a month and sees a number go slightly up or slightly down. One of these feels like real wealth. The other feels like nothing is happening. Here's what makes this comparison so important. Most people choose their investment based on how it feels, not what the full math actually shows. Real estate feels real because you can touch it, show it, and talk about it. Index funds feel invisible because they live on a screen. But over 10 and 20 years, the numbers tell a story that is completely different from what either investor expected when they started. And that story is exactly what we are breaking down today. Sarah collects $1,800 a month in rent. Her mortgage payment is $1,330. On paper, that looks like $470 profit every single month. She feels like a genius. But here's what nobody tells you about that $470 number. It is completely fictional, because before Sarah keeps a single dollar, she has to pay property taxes, insurance, maintenance, repairs, and the cost of her own time managing everything. Let us look at what actually comes out of that rent check. Property taxes run about $3,000 a year. Insurance adds another $1,500. The general rule is to budget 1 to 2% of property value annually for maintenance. That is $2,500 to $5,000 on a $250 property. Some years it is a small faucet fix. Then there's vacancy. The average rental property sits empty about 1 month per year. That is a full mortgage payment with zero income to cover it. And when a tenant leaves, you pay for cleaning, repairs, and your own time to screen and show the property again. Then there's the risk nobody likes to talk about. A bad tenant who knows the eviction process can cost you 3 to 6 months of lost rent plus legal fees. That single event can erase an entire year of profit or more. After 3 years of real landlord expenses, Sarah's actual net cash flow is somewhere between $2,000 and $4,000 total. Not the $16,000 that looks so good on paper. And that number does not account for a single hour of her time spent managing tenants, coordinating repairs, and handling emergencies on her lunch break. Meanwhile, David has done absolutely nothing except watch his portfolio grow from $50,000 to approximately $76,000. But here's where Sarah has a genuine powerful advantage that David simply cannot replicate easily. Leverage. Sarah used $50,000 to control a $250,000 asset. That is 5 to 1 leverage. When her property appreciates 3 to 4% annually, her $50,000 investment is growing on the full $250,000 value, not just on her down payment. After 3 years, her property is worth approximately $270,000 to $280,000. Her equity, the difference between what the house is worth and what she still owes, has grown to roughly $55,000 to $65,000. That is real wealth that came partly from using the bank's money to grow her investment. This leverage advantage is the single biggest reason real estate creates more millionaires than the stock market in many studies. David used $50,000 to control $50,000. Sarah used $50,000 to control $250,000. Real estate also comes with tax advantages that stock investors simply do not have access to. Depreciation allows property owners to deduct the theoretical decline in their building's value from taxable income even when the property is actually appreciating in value. That is a legal tax shelter worth thousands of dollars annually. Plus, mortgage interest deductions reduce Sarah's tax bill further every single year she holds the property. So at year 5, Sarah's real picture looks like this. Property worth approximately $300,000, equity around $80,000 to $90,000, actual cash flow after all real expenses hovering around 3 to 5% cash on cash return, not the 20% she mentioned at dinner parties, but the leverage and appreciation are genuinely building wealth in ways that are harder to see on a monthly basis. Year 10 is where this gets genuinely interesting. Sarah's property is now worth approximately $335,000 to $350,000. Her remaining mortgage balance is around $166,000. That puts her equity at approximately $170,000 to $184,000. Real wealth built over a decade. But she also spent over $20,000 beyond her original investment in unexpected costs and hundreds of hours managing the property over 10 years. David's portfolio with consistent monthly contributions and 10% average annual returns is sitting at approximately $165,000 to $180,000. He put in $50,000 up front plus $36,000 in contributions, $86,000 total out of pocket. The rest is pure compound growth, and he spent exactly 0 weekends fixing anything, 0 emergency phone calls, 0 tenant drama. At year 10, they are surprisingly close in total wealth. Sarah might be slightly ahead thanks to leverage and appreciation, but Sarah also took on hundreds of thousands in debt, concentrated her entire investment in one asset in one location, and spent enormous amounts of time and stress managing it. David diversified across thousands of companies worldwide and never lost a single night of sleep over his investment. Same destination, completely different journey to get there. This is the moment most real estate versus stocks comparisons stop. They show you year 10 and declare a winner. But year 10 is not where the real story is. Because between year 10 and year 20, something happens to David's portfolio that completely changes the math. Compounding stops being boring and becomes genuinely extraordinary. The gains on his gains are now generating more new wealth each year than his original contributions ever did. This is where everything separates. Year 20, Sarah's property is now worth approximately $450,000 to $500,000. Her mortgage is either paid off or nearly there. Her equity sits somewhere between $400,000 and $500,000 depending on appreciation in her specific market. She has been collecting rent the entire time. David's portfolio at 10% average annual return with consistent monthly contributions has grown to approximately $420,000 to $460,000. His total contributions over 20 years were $122,000. The other $300,000 plus is pure compounding. No debt, no tenants, no 2 in the morning phone calls about broken pipes, no concentration risk in one zip code. When you compare final net worth at year 20, they are in the same ballpark, both somewhere between $400,000 and $500,000, but how they got there is completely different. Sarah worked for hers, David waited for his. Sarah had stressed debt concentration and her money locked in one liquid asset. David had market volatility but complete liquidity and total freedom to change his mind at any point along the way. Same result, completely different experience getting there. And here is the part that changes the math dramatically in David's favor. If David increased his monthly contribution by just $200, bringing it to $500 a month, his 20-year portfolio jumps to approximately $550,000 to $600,000. In the stock market, increasing your contribution has a multiplied effect through compounding. If I only showed you real estate downsides, I would be doing exactly what stock market influencers do. Both investments carry real risks that deserve honest attention. Stock market volatility is brutal in ways that numbers alone do not capture. In 2008, the market dropped 37%. In early 2020, it dropped 34% in a single month. Most retail investors panic sell during crashes and buy back in after recovery, locking in losses at the worst possible moment. Index funds also produce no monthly cash flow. Unlike rental income, dividends on a total market fund run about 1.5% to 2% yield. On $150,000, that is roughly $200 a month. That is not replacing anyone's income. Real estate wins clearly in specific situations. If you are in a market where monthly rent is at least 0.8% to 1% of the purchase price, the cash flow math genuinely works from day one. If you are willing to treat it as a real business, not a side hustle, screening tenants carefully and budgeting for every expense, the returns can exceed stocks, especially with leverage working in your favor. Index funds win clearly when you value time, freedom, and simplicity. When you want diversification across thousands of companies, instead of concentration in one asset, one city, one tenant. When you want the ability to increase or decrease your investment instantly without taking on debt or dealing with anyone. And when you want compound growth that accelerates dramatically in the back half of a 20-year period, in a way that real estate cash flow simply cannot replicate at the same scale. So which one actually wins? Here's the honest answer that most YouTube videos refuse to give you. It depends entirely on you, not on which investment is objectively better, on what you actually want from your money in your life. Do you want monthly cash flow you can touch and spend right now? Real estate done correctly in the right market gives you that in ways index funds cannot match until your portfolio is very large. You want complete time freedom and zero management responsibility. Index funds give you that in a way no rental property ever will. You want to use leverage to control assets larger than your initial investment. Real estate gives you 5-to-1 leverage that stock investors simply cannot access without taking on significant additional risk. You want both. Then own property in a strong rental market and invest consistently in index funds simultaneously. The real trap is not real estate and it is not stocks. The real trap is choosing either one based on a YouTube headline, a podcast clip, or something someone told you without ever sitting down and running the complete numbers for your specific situation. Your income, your market, your risk tolerance, your available time, your financial goals. The answer that includes all of those variables honestly is the only answer that actually matters for you specifically. Next time someone tells you real estate always wins or stocks always win, ask them one question. Did you include everything? The hidden costs, the time invested, the stress, the risk concentration, the liquidity difference, and the full 20-year compound growth curve. Because the answer that includes everything is the only answer worth listening to. If this broke it down clearly for you, subscribe now, because next week we are running the same honest math on something that will surprise you even more.